Hi guys, thanks for joining me once again. This is the fourth part of our series, fourth part of the webinar, which is about the 10 components to successful trading. And today I'm going to talk about a subject that's really going to help you, I hope, with your trading. And it's when I first started learning to trade, it seemed to me to be a rather dull subject, and the subject is risk. However, as I learned to trade, I understood that managing the risk on each trade and managing the risk associated that you're taking with your trading account is almost definitely one of the most important parts to trading. And your trading account represents a connection, that's a living connection that's always with you, with your dream. And so we need to preserve that dream, we need to look after that dream and be careful with it. And we do that by managing each trade really, really carefully. Okay, so by managing trades, what I'm actually talking about is, I'm talking about, the thing when I first started learning to trade again, the thing that I always heard that people need to do to be successful in trading is they need to let their winners run and they need to cut their losses short. And I remember thinking, okay, yeah, that makes sense. That's, kind of obvious. You need to do that. And, so I started trading, and the question remained with me, which was how? How do I know when to let my winners run? Because I'd let my winners run and the price would turn around, go in the opposite direction, and I'd end up having a loser. And I would cut my losses short, and the same thing would happen. The market would turn around, and I would make a loss on the trade, and the trade, if I'd have stayed in it, would turn around, the market turned around, and the trade would have been a winner. So the question remained with me, how? And that's a skill, that's the skill of trading. It's something that you learn with the right strategies, the right techniques, and the right trading systems. However, part of your system needs to incorporate risk, managing risk. Now, what I'm talking about in terms of risk is, let's just say, for example, the market is doing this. So it's doing this, and we think, oh, the market's going to go up. So we place an order here, just at this level here, to buy. So a buy order. And so what do? How do we manage our risk associated with that? Well, when we're actually placing an order, we're placing an order to buy or sell, but in our mind, we have to bear in mind that we're actually placing 3 orders. We're placing 3 orders at once. So what we're doing is we're saying, okay, well, that's our entry level. However, this is the level that I'm getting out if I'm wrong. So this is the difference between where we're entering and where we're exiting. This is our risk. So we're effectively placing an order here as well to exit the trade. And we're at the same time thinking, okay, if I'm right and the market does go up, then I'm going to take my reward here. Okay, so the difference between where we enter and where we're going to exit for a profit is our reward. Okay, and so 3 orders, we're bearing in mind 3 orders at once rather than just one. And so we can define our risk per trade at the entry of the trade, but we must have already made that decision. And we can be in no doubt, okay? When we enter a trade, we can be in no doubt as to how much we're risking per trade. Because if we decide that we're out of the trade, if the market reaches this level, then it doesn't matter, it doesn't matter whether it takes 2 minutes or whether it takes 4 hours or 4 weeks. When the market reaches this level, then we're out, and that's when we take a loss. We take a loss because the market has taken us out, and the loss is defined by our position size and the number of points, or the number of the size, the difference between the entry point and the risk. So that's our risk is defined at outset. Under no circumstances do I ever let the market go against me and see what happens. Wait for it to turn around. I never do that, and I never do that because I've heard too many stories of disasters occurring. The market will carry on and do what it wants to do. It doesn't care about the size of my potential loss, and it could carry on and drop to a level that is, where the loss is really, really huge, and nobody's going to care apart from me. So I won't let that happen. It'll never happen to me. I define my risk at outset, and I've always done that. And it works successfully for me. So we're defining our risk, and we're defining our profit target. And if and when the market goes up, let's say we have a period of time, we've got our risk defined down here, and so the market comes down, nearly hits our risk level, our protective stop, but doesn't, and it carries on, and eventually it makes our target. Likewise, at that level, I'm definitely out of the market. I've taken my reward. This is my reward level. Okay, so what I need to decide before I place a trade, let's say my entry level was here, what I need to define at outset is, how does the level of my risk compare to the level of my reward? And I'll always consider trades, or only consider trades, where my reward is greater, my potential reward is greater than my actual or initial risk. Okay, so the difference between the entry price and the level at which I decide to get out, that's called I decided at outset, and that's called my initial risk. Okay, it's my initial risk, and under certain circumstances I may narrow the gap, which means I might decide at some stage during the trade that I'm going to get out early, and therefore my initial risk might not be my actual risk within a trade, but I'll define that for definite at outset, and I'll also define my reward level as well, so my profit level. I'll put a question mark there because we never know. And so they're defined at outset, and so I'm managing my business. If you think about a businessman, think about being a businessman, and how do you create income? Well, you create it through doing marketing. So you have to spend money on marketing in order to get your profits. So you might decide to spend $1,000 and hope that $1,000 spend is going to generate an income of $2,000. And so that at outset, that's what you've defined at outset. The $1,000 is what it's going to cost you. Hopefully you agree with contractors, your employees, or whoever's doing the work for you, that you agree a price, and it's $1,000. That's it. That's your risk. And you don't quite know what your reward is, and that's one of our advantages in trading, is we can set definite levels that we decide are where we are going to exit. So we can decide our spend, and we can decide our potential profit as well. And it's just like running a business. If you keep taking trades where your spend is £1,000 and you spend £1,000 and you get no reward, because you keep losing, in trading terms, if as a businessman, you keep spending £1,000 and nobody replies, nobody is interested in your marketing, nobody's interested in your product, then eventually you change your marketing strategy. Same in trading. If you keep having losses, then eventually you're going to change your trading strategy and make it more effective for you, and eventually you get your balance right between the risk and the reward. And the best way to do that is to make sure that on every trade your profit potential, because we can define that, one of our edges over the market, we can define our profit potential, and we can define our definite spend, our risk, our potential loss on each trade. We need to get that correct. Now, you can, in most trading software, most trading brokers nowadays with their software offer the opportunity for us to place bracket orders. So when we place an initial buy or sell order, we can also place a profit taking level and a risk level. So we can do that immediately. Sometimes I use bracket orders, and sometimes I just place a buy or a sell order to enter the market at a certain level, and I will have in mind the levels at which I will exit. And it depends on what the market's doing, as to whether and which market is I'm trading as well, how liquid the market is, i.e. how easy it's going to be for me to have my orders met at some point in time. But for absolute definite, my risk level is set, and if the market reaches that level, then I'm out. So I know what I'm going to spend, and that's how I manage my account over time, and that's how you as a trader should manage your account over time as well, by having in mind before each trade entry your 3 orders: your entry order, your stop loss level, and your profit target. So let's have a think about stop losses, protective stops, and risk in a little bit more detail then, because it might seem to you, as it did to me, that, you know, if I've got to let my profits run and cut my losses short, that it's sensible to keep the stop loss as close to the entry, the order entry, as possible, because that limits the risk, doesn't it? So if we're going to enter the market long here, let's say at this point here, then why not just put the stop loss here? You know, that's not much risk, is it? The difference between here, that's not a lot of risk. So it might seem sensible to do that, and then hope the market just goes straight up to my profit target. And it might seem sensible to do that, and that isn't the way to trade, I'm afraid. It's not as easy as that trading, because 9 times out of 10 or 99 times out of 100, you know, the stop loss will be hit under those circumstances. The market doesn't go just in one direction, it zigzags. I call it the zigzag. It zigzags, it moves like this. That's what the market moves like. It might go up and hit your target level, but the chances are that it will also hit your stop loss level as well within the zigzag. Okay, bear in mind that the price chart, the way a market behaves, is purely representing an interaction between supply and demand. Okay, and in the middle somewhere there is something called value, okay, or a value average if you like. So the market will start at a certain level and it will go down and find that there are buyers there. It will then go up and find that the same people who sold, let's say here, will sell again here, and they'll sell again here, and they'll sell again here. The same people who are buying here will buy again here, and they'll buy again here. This creates this zigzagging motion within the price action, within the market, within every market. This is how markets operate. So your trading strategy in terms of risk and reward need to take this into consideration. So in this sort of scenario, if you've got a market like that and you reach, let's say, we reach this level here, then your stop loss level, to be sensible, needs to be down here somewhere. And you know, you've got to think, well, it's looking as though it's gradually going up. You know, where's a reasonable profit target? Well, that might be, you know, you may get that as a profit target. So you're entering here, and so, or let's say the market is at that level and you're contemplating entering there. Well, does that make sense in terms of a trade? Probably not, because this is the entry level. That would be your reward, and this would be your potential risk. Okay, And in this case, the reward is there. The reward is less than the risk there. So it doesn't make sense to take that particular trade. So, and the reason it doesn't make sense is because, the market is zigzagging, and sometimes the market is going to go down here and people are going to continue selling. And it's going to go down there, it's going to take you out, and you're going to have a loss. And so it doesn't make sense to, the equation within the trade isn't a sensible equation. Sometimes that's going to happen, and, is it going to happen 50% of the time? Well, it might do. But overall, you need to make sure that your reward is bigger than the actual risk, which is where you would get out if you're wrong. You need to make sure that we get that equation correct. Now, there are scenarios in the market where actually the potential loss, the potential win to loss ratio is 100% loss. So the market's doing this, let's say, and you think, we get to this level here, and you think, or I think, I'm going to take a buy trade at this level. Buyers will be down here. They've bought here, they're going to buy again here. So you enter a buy order, and you maybe put a stop loss in here. So quite tight, very small stop loss. There's not much risk on the trade. What have I got to lose? Well, the thing is that, if it happens, if your stop loss gets hit 100 times out of 100 trades, then there's a lot to lose, and we need to bear that in mind as traders. So in this sort of scenario, you need to extend your stop loss. In actual fact, is it a sensible time to take a trade? Well, no, the chances are it's not a sensible time to take a trade most of the time in the market, which is why most strategies in trading don't work. There are good times to trade and there are poor times to trade. This may turn out to be a really good time to trade, but we don't know that yet, and therefore we need to define what our criteria for entry are at outset, what our criteria for taking risk is, and what our criteria for taking our profits are. That needs to be all defined within our trading strategy. But sometimes, you might think here, I could buy, going to put my risk there. You might think I'm going to sell, it's gone below these levels here. It's going to carry on down, and therefore you might decide to sell and put your risk, your stop loss for, if the market goes up, put that here. And the market has its own ideas, as it always does. The market might do this, it might go up here and then down here. Now, it depends where you've put your take profit levels, but in this sort of scenario, if let's say your take profit level, you buy, you put your risk down here, your stop loss down here, and you put your target up here to get a good reward to risk ratio, then did the market go up to a level where you took your profit? No, it came down and it took you out for your loss. If we went in the other direction, let's say we decided to place a sell order here and the market did that, then you may have placed your risk here above these highs here. You may have placed your risk there and your target down here somewhere, and the market went straight away up and it took you out for your loss. So in both scenarios there, it didn't matter at this stage whether you placed a buy order or whether you placed a sell order. In either case, the market would have taken you out for a loss, because it all depends where your take profit levels are and where your stop loss levels are. And if they're within the zigzag, as I call it, then more often than not, you're going to have a losing trade. So generally, wherever your buy and sell orders are to enter your trades, your stop losses need to be outside of the zigzag, and learning and understanding where value is within a market and where prices are likely to go, of course. And prices price likes to populate areas it's been before, because the market knows there are buyers and there are sellers in those particular areas. It loves populating areas that have already been visited before, and it likes less going to areas that haven't been visited by price in the recent past. And so managing that is what managing your trades is all about, and that's what trading account protection is all about.